Hello. Today we are discussing about the capital budgeting. Capital budgeting is about the long-term investment. Its first technique, that is NPV. NPV is a discounted cash flow based technique. In NPV, you found out the present value cash inflow minus present value cash outflow. When your inflows are greater than your investments, investment is your present value cash outflow, and inflows are the future yield or future return that you will get, and you discount it into the present. If it is greater than the present value cash outflow, it means your project will go on a positive, and we will discuss the problems on that. Okay, so you can see in other videos the problem on the NPV. Our second technique is that is also discounted cash flow based. One is called as discounting, other one is called as compounding. As you know that when you convert the present value into future value, that is called compounding. When you convert the future value into the present value, that is called discounting. Here, whatever the output you will get in number of years in future, that you will discount it. That's called discounted cash flow. Okay. So internal rate of return. Here IRR, when your NPV becomes zero, net present value cash inflow and outflow, that is called as internal rate of return. When you know that internal rate of return, for example, your internal rate of return is 10% and your required rate of return is 5%, it means that you will go for project, because you require 5% and you are getting in the project 10%, you will go for that project. If your internal rate of return is 10% and you require 12%, then certainly you will reject that project, because your required rate of return is more. Here this is to take the project when IRR exceeds the required rate of return, because your IRR should exceed the required rate of return. If your required rate of return is 8% or 5% and your internal rate of return is more 10%, 12%, then certainly you will go for that project. Okay, and we will do the empirical problems on that. You can see in other videos. Profitability index. Profitability index is a cost benefit cost ratio, is a when it's have a simple formula, that present value cash inflow divided by present value cash outflows. When your investments exceeds the one, then you go for a profitability index technique. Okay, here payback period. Payback period is a payback criteria in how many number of years you get your back investment or your cost. Payback period is the length of time until the sum of an investment cash flow equals its cost. Means whatever you make an investment, for example, if you make an investment of 1 lakh and you are getting the output in 5 years, then number of years will be 5. So here you can say your payback period is 5 years. Okay. And second payback technique is discounted payback. Here you count your discounted amount, not the original amount but your discounted amount. Okay, discounted amount, you can see in other problems that what is the discounted amount. In the empirical problems it will clarify you that what is the discounted amount, so it will give you clarification between payback period and discounted payback period. Okay, discounted payback period is the length of time until the sum of investment discounted cash flows equals discount. Whatever the investment you make, for example 1 lakh, that you get the output discounted outback or discounted amount in a return is equal to 1 lakh is called as discounted payback. For clarification, you can see other videos relating to discounted payback period, and you can see the problems as we have solved, and that will help you to clarify the payback and discounted payback. Okay, then our fifth technique is sixth technique, average accounting return. Average accounting return is the measure of accounting profitable relative to the book value. This is to take the investment if it exceeds the AAR, a benchmark. On this, you can also refer to our problem that will give you clarification to relating to all these 6 techniques. Each technique along with the problem is solved. Okay, so you can see and refer along with this theory. You can if you will find out the practical solution of a few problems that will help you to find out the long-term investment decisions. That's called as capital budgeting. So I hope you will refer the problems relating to the each and every technique, one problem with that refer related with technique. So thank you very much.